Welcome back to Business 150, Introduction to Management. And in this video, we continue our look in Module 6 at the topic of planning and strategy. And as you can see in this title slide, what we're considering in this video is the notion of corporate strategy. And corporate strategy means something very specific. When we talk about the broad topic of strategy, we're really talking about how do diversified corporations make decisions about departments and divisions that they currently have in their roster of businesses. Well, that really requires some explanation. What are we talking about? And we hope that after this video, you'll be able to differentiate among the major corporate strategies and tools that managers use to develop and implement corporate level strategy. So we need some definition here. Remember that management is all about accomplishing organizational goals with two attributes, at least: effectiveness, in other words, choosing to do the right thing, and efficiency, choosing to do things right. Now, we want to also provide, as you can see underneath, a variety of context for this. There is functional level strategy, there is business level strategy, and finally there is corporate level strategy. And really what we're talking about in this particular video is the kinds of challenges represented by what we call corporate level strategy. What is corporate strategy? It's concerned with the organization as a whole, particularly diversified corporations that own and operate several different businesses. Now, realize not every corporation operates several different businesses, but many large businesses have diversified to the point where they have multiple divisions, multiple departments, multiple things going on. Let me see if I can give you some examples of this. There is a automobile manufacturer that we know as the Toyota Corporation, and the Toyota Corporation operated at least 3 different brands during its lifetime: the Toyota brand, the Lexus brand, and the Scion brand of automobiles. And respectively, Scion was an entry-level brand, Toyota was the broad brand for all sorts of different consumers, and Lexus is positioned as a luxury brand within the parent company, the Toyota Motor Corporation. That's an example of a company that owns and operates more than one business. There are others, of course. You may be familiar with the Samsung Corporation. Here in the United States, we know Samsung as a corporation primarily responsible for consumer electronics, right? Flat screen televisions, Android phones, those kinds of things, right? Consumer electronics. However, you might be surprised to know that Samsung operates many different businesses around the world. They are one of the world's largest commercial shipbuilders. Samsung also has a very large commercial construction department that builds large office buildings around the world. Samsung's perhaps their most profitable division, we don't even know about here in the United States. Samsung is one of South Korea's largest sellers of insurance, and that's really where the great lion's share of their profit comes from. We just don't know them for that because they don't sell insurance here in the United States. That too is an example of a corporation that owns and operates many different business divisions. And so that within that context, then corporate strategy means if a company operates many businesses, corporate level strategy should account for the relationship among these. And so you can see here 3 general corporate level strategies are: number 1, diversification; number 2, joint ventures; and number 3, divestment. Let's see if we can talk about that a little bit. When a company owns several different business divisions, the corporate parent operates a lot like, well, an investment bank. In other words, every year that parent corporation is asking themselves the question, among these many different divisions that I operate, where should I allocate capital and resources? Where should I dedicate more funding? Where should I acknowledge and have more hiring? And the tools that are used to assess where should I allocate capital and resources, you see them listed here. There's one tool called the Bcg Matrix, the Boston Consulting Group's Growth and Share Matrix. And you can see that described there in the second bullet point. It's a 4-grid matrix that essentially ranks and identifies strategic business units either as stars, question marks, cash cows, or dogs. And we'll take a look at that tool so that makes a little more sense than just what you see described there in that second bullet point. That's one tool, the Bcg Matrix. There is another tool, the GE Matrix, that was created by the General Electric Corporation, which instead of a 4-grid matrix has a 9-grid matrix and does the same thing. It sort of ranks different business units among these 9 categories rather than 4. We'll take a look at that as well so you can get a visual picture of what that really looks like. But basically, these tools allow an organization to categorize its businesses and then to look and examine its relative performance and strength of each of them, and therefore use that to answer the question, where should I allocate capital and resources to grow my different business units? So here's an example of the Boston Consulting Group Matrix. Notice before we even talk about these funny pictures, okay, notice that the horizontal axis is labeled market share, and the vertical axis is labeled growth rate. So what does this mean? Let's say that this corporation that was performing this analysis owns at least 4 different business units, and the first business unit it looks at has a very high percentage of market share, right? They have close to 50% market share. 50% of the consumers in that market buy their products from that business unit, right? And not only do they have a high degree of market share, but that market itself has a very high growth rate. It seems to be expanding and growing, just catching on, and therefore you would rate that company a superstar. That's, you see the little animated star there. With both high market share and high growth rate, you have great potential for future growth. That you would categorize as a superstar. Well, what if you have high market share, but the industry itself has a low growth rate? Well, that's what we describe as a cash cow. You see there in the lower left-hand cell of this 4-cell matrix. The cash cow means that, well, the growth rate, because the growth rate's slow, you're not going to get enormous amount of future growth, but what you do have is high market share, so you just keep milking the cow to provide more and more cash for as long as you can until the party is over. Okay? It's a great source of cash and profit. This just won't be going anywhere, likely, because of the low growth rate. All right. Well, then let's move over then to where we see that cute little dog sleeping there, right? Pretty lethargic, just resting. And what is that? That's a business unit with a low degree of market share and also in an industry with a pretty low growth rate. Low market share, low growth rate. What does that mean? We categorize that business unit as a dog. Not very much profit and not very much future growth. Why do we even have this thing around? Maybe that is a business unit we should think of not being in that business. So the real odd one then becomes when you see a business unit with a low degree of market share, but in an industry with a potential high growth rate. That's where you see the question mark. Well, we're not really sure what's going to happen in the future. Maybe this could be a future opportunity we should invest in now. Is there a way to do more research to get a better sense that even though presently it doesn't enjoy a large degree of the market, perhaps with future growth promised in that industry, it really could end up to be perhaps a superstar or a cash cow over time. So you get the sense of how you use this tool to analyze these two factors, market share and growth rate, to better understand where are business units that might be a great opportunity to invest more capital and resources, and others that maybe are not. Now, let's look at this next slide. This is no longer the BCG matrix, this is the GE matrix. And the GE matrix, as you can see here, rather than 4, it now expands into 9 different possible categorizations. And you notice that the axes have changed, the labels have changed. Instead of market share, we now have business strengths. And rather than industry growth rate, we have industry attractiveness. And essentially, General Electric has a long history of being a highly diversified corporation with lots of different business units. You may know this, of course. General Electric makes what? Well, they make refrigerators, but they also make jet engines. Oh, but they also make light bulbs. Oh, but they also have a consumer credit division. GE does all of those things, right? Very highly diversified corporation. And so essentially what they've done is taken the same principle as the BCG matrix, and instead of only market share, business strengths includes all sorts of factors to consider, including market share, including the innovation of products, including is the market share declining or not, and what is the real health of that market. There's a lot of different things that go into the consideration of business strengths. Whereas industry attractiveness on the vertical axis now is no longer simply growth rate, but also what are the future prospects for that entire industry, not just along growth, but along sociocultural and regulatory lines, all sorts of other things that might also factor into the broader principle of how attractive an industry is to be in. And along those lines, then, we begin to rate and analyze the attractiveness of particular business units. And the same kind of thing, right, is that the ones in the business units in the upper left-hand corner of this 9-grid matrix will be very attractive. The ones in the lower right-hand corner will be very unattractive. And then the ones in the upper right-hand corner will just simply be question marks. We're not really sure, just based on this matrix, whether or not this might be a great investment or not. But again, when we step back, what you're really looking at is a way to analyze the relative health and performance, and therefore attractiveness, of different business units that you have under your corporate umbrella, all operating in different industries. So why do we talk about this? It is because, generally speaking, the type of corporate strategy that says, as a parent corporation, I want to own several different business units in different industries, is an example of portfolio diversification. What is diversification? Diversification is a risk management strategy that mixes a wide variety of investments into a single portfolio. What is the point of having a wide variety of investments within the same portfolio? Well, you can see there. A diversified portfolio contains a mix of distinct asset types and investment vehicles in order to limit your risk and exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower risk and lower the risk of any individual's particular holding or security, or in this case, business unit. What does this mean in plain English? Here's what it means. Let's say that you're thinking of buying some stocks, and you decide to buy 100 shares of stock in Amazon.com. Everyone says Amazon's a great company. You're going to own 100 shares of stock in Amazon.com. That's wonderful. That's really great. That's awesome, and it'll probably perform well for you. But what happens if the government files a lawsuit, an antitrust monopoly lawsuit against Amazon, and the price drops? Yeah, a single security, a single stock holding represents a pretty risky investment, because lots of things can affect the company's future, right? So instead of investing in 100 shares of Amazon, what if you only bought 2 shares of Amazon and, well, 2 shares of Apple Corporation and 2 shares of a mutual fund and 2 shares of Bank of America and 2 shares of Pfizer Pharmaceutical, and you get the point, right? By buying a little bit in several different investment vehicles, which represent entirely different industries, you've lowered the risk that any one setback to one company will negatively affect your entire portfolio. In fact, you spread your risk across different industries, and it is very possible and very likely you will on average yield a higher long-term return with much lower risk than investing in just a single security, a single stock. That's the exact logic behind a corporate parent building a diversified portfolio of different business units. Think of General Electric for a moment. They build jet engines, which can be profitable unless there's a downturn in the jet engine market. But that's okay because they don't have all their eggs in one basket, right? Because they also have a consumer credit division, which is backing a bunch of consumer credit cards. And so if life gets bad in the jet engine business, maybe it's still okay in the consumer credit business, or the refrigerator business, or all of the other divisions and business units that General Electric holds in their portfolio. So we hope that as you consider this whole topic of diversification, and makes sense why, at least for some big corporations, they need strategic tools to analyze the different companies and measure relative attractiveness, and therefore answering the question, where should I commit more resources and where should I grow my healthiest and most attractive business units? That's really the point of corporate strategy, corporate level strategy, at least in this video. So we hope that this has been useful to you, helps you to consider some things in your managerial life. Hope that's useful. We'll see you in the next video. Take care.